Phil Muscatello and FinPods are authorised reps of Money Sherpa. The information in this podcast is general in nature and doesn't take into account your personal situation. Shares for beginners. Weekend Watchlist.
G'day and welcome back to Shares for Beginners Weekend Watchlist, where we take a close look at an individual company that you may wish to consider for your watchlist. It's not a recommendation to buy, but a way for you to learn how Stockopedia screens for value. Joining me today is Chris Batchelor, and we're talking Brambles, ASX code BXB. G'day, Chris.
G'day, Phil. Great to be with you again.
Thanks very much. Now, this company, it reminds me, I'm not sure if you remember a movie called Mystery Men. It was around, I don't know, maybe 20 years ago. It was a low-budget, a US movie, and it was about a city full of second-rate superheroes. And one of the main superheroes was the Shoveler, played by William H. Macy. And he was trying to explain himself to his wife about what he does. And he said, "I shovel well. I shovel very well." And that reminded me of Brambles. They do pallets well. They do pallets very well. What's your thoughts?
Yeah, that's probably a pretty good take on it. It's one of those companies that flies below the radar, and unless you're in that sort of sector, you've probably never heard of them. In fact, their main business, they don't even use the Brambles brand. That's called CHEP. And yeah, they do pallets. So we're all not directly using pallets, but we're indirectly all using pallets every day. Every time you go to the supermarket, a big box of cereal or whatever has been delivered on a pallet, and millions of these things circulating around the economy. And as you said, they do pallets very well. They are the world's largest pallet provider and dominate all the markets where they operate. And that's primarily North America, Europe, and of course here in Australia and indeed Asia-Pacific. They're very much an Australian company, established way back in 1875 and listed back in 1954. So a very long and storied history within the Australian stock market, and actually have a market capitalisation of $20 billion. So they're a very significant business on our market. Right now they do pallets, and as you said, they do them very well. Over their history, they have done a bunch of other things. People may be familiar with the Cleanaway business, waste management business. They owned that for a long period of time, but then they sold that down. They also owned a business called Recall, which was a records management business. They divested that as well. And now they focus purely on the pallets business. And as I mentioned, they really are the dominant player in that space. In the US and Canada, they've got 45% market share, 35% in Latin America. And just sort of putting that into context, in North America, their nearest competitor only has 10%. So they're like, what's that, 4.5 times larger than their nearest competitor. Europe, they've got 33% of market share. Australia, they've got 75%. And they're basically got one other competitor, a firm called Loscam, and that firm holds 25, the remainder. So yeah, they generate 55% of their revenue in America, or the Americas, so North and South America, and 37% from the Europe, Middle East and Africa markets, and only 8% from Asia-Pacific. So whilst we like to call them an Australian company, and were formed here, they really are generating most of their revenue from overseas markets these days.
So the Brambles CHEP business model is not selling pallets, as you would kind of think might be the case. Can you explain the concept of share and reuse that they use?
Yeah, I can. So like you say, your sort of first thought is that they would receive a fee for providing someone with a pallet, which they kind of do, but the model is that they basically sort of lend the pallet to the customer, and then they collect it when the customer has finished with the pallet. However, they don't charge based on the amount of time that the customer has the pallet. So they're looking for customers to use and return the pallets. And one of the big sort of pushes, if you like, one of the things that they like to wave the flag about is this whole sustainability proposition. And they talk very much about circular economy, and the whole concept is that pallets are sourced from trees. So initially your thought is, oh, that's not good, you're chopping down forests. But they're very much about using renewable forests and then not using them too much. In other words, using that wood over and over again, using the pallet over and over again. And they actually promote to their customers the benefit of being able to say, I use CHEP pallets, therefore my contribution to global warming is less. And companies brag about, this is as a contribution to their strategy to, reduce their net zero and all of that, which is very much in favor at the moment. So yeah, the whole concept basically is that you need a pallet. Okay, we'll give you a pallet. You use it till you're finished with it. Then you give it back to us, and then we give it to someone else. We keep those pallets in circulation. And that then flows into their bottom line, because when we sort of start to study their numbers, we can see that the biggest capital expenditure item for them is when they have to produce new pallets. And that was very pronounced during the pandemic. Customers started hoarding pallets because of the whole supply chain challenges that we're all kind of familiar with now. And so they had to produce extra pallets, and that impacted their cash flow. But in the last 12 months or 18 months, people have been returning pallets. So they've had a net inflow of pallets, and that therefore reduces their capital expenditure.
Let's touch briefly on their digital transformation, and I'll do the little quote marks around that. They do have a plan for a digital transformation, and you think that with this kind of hardware moving around the planet, that they could use some sort of digital means to help with stock control, inventory and placement and so forth. But it's not really that well advanced, is it?
No, that's right. I mean, yes, they are doing it, and they have some pilot programs in place. And, when I just looking this up, and they said they have 450,000 pallets fitted with autonomous tracking devices. And at first you think, oh, that's good, that's a large number. And then you think, actually, they've got millions and millions of pallets in their inventory, and 450K is actually a very small subset that they're fitting with these tracking devices.
And they're not that smart, the tracking devices as well. You think that weight would be a factor as well, for example.
Yes, yeah. So, yeah, they are trying to make some moves towards utilizing data analytics and trying to understand where those pallets are and how they're being used. I think one of the things that they're trying to crack down on a bit is what they call uncompensated flows, which I gather would be like, they give a pallet to a particular customer, and instead of returning it, that customer gives it to somebody else rather than, and that means that they're not getting the revenue from that second party using the pallet. So they're trying to track that sort of thing, but it is small. They're doing a trial in Chile, for example, where they put unique tags on pallets. And yeah, they've got a digital interface, as everyone does these days, and try to improve their customer service through that forum.
Yeah, at least they're not trying to trumpet an AI capability like everyone else is at the moment.
I'm sure that'll come next year.
That'll be next year, the AI transformation. Yeah. So getting back to the Stockopedia score, it's got a high quality, a momentum and overall stock rank, and the value score is not as low as we often see with such excellent companies.
Yeah, that's right. It looks quite favourable in most of those metrics, and yeah, we'll touch on value in a minute. But ROE, so return on equity, that is in the sort of mid-20s, and that's grown from around 14% 5 years ago. So it's really improved considerably. Operating margins, 16% consistently, and most recently hit 17.9%. Earnings per share growing at almost 10% per year over the last 5 years, and indeed at 13% over the last 3 years. So these are really good metrics, and the company is really delivering in terms of their financial returns. We'll touch on the negative side of that in a moment, but their operating cash flow is very high when compared to their profits. And then CapEx, as we mentioned, fluctuates a bit based on the amount of pallets that they need to produce. And so there have been some negative years, particularly during the pandemic, in the free cash flow when CapEx was high. But most recently, that was positive because of that net returns of pallets. So yeah, generally, the trend in their financials is really strong. The one sort of glitch on that, if you like to call it that, is when we look at the bankruptcy risk as highlighted in Stockopedia, it's in the cautious zone. And so naturally I dug into that to try and understand what's going on there. And there are a few factors at play that are contributing to that. One is a low current ratio. So current ratio measures your current assets, so things like trade receivables, inventories, against your current liabilities, which primarily is your trade payable, what you owe to your suppliers. And we see that they have significantly higher trade payables than they do trade receivables. So on the face of it, they're paying out more than they're owed, put it simply. Also, when we look at asset efficiency, one of the measures that we like to use is a thing called the sales to total assets ratio. And what that basically tells you is how many assets do you need to generate $1 of revenue? And you're looking for that number to be as high as possible, obviously. But in this case, it's only 0.7, which means that they've got net fixed assets of roughly $7 billion, but that's only generating $6.4 billion in revenue. So there's a lot of investment tied up in assets in order to try and generate that revenue. So that, all things considered, that's a fairly inefficient thing. And 70% of those total assets is actually the pallet pool. That's really where all their money goes, is in building these wooden pallets. They've also got quite a bit of debt. So net debt to equity is 64%, or if you add in the leases, it takes it right up to 88%. So that's not quite alarming, but it's certainly considerable. So yeah, all of those factors are contributing to this bankruptcy risk. Now, I wouldn't say that it's a company that I would be anxious about, but it's one just to keep an eye on some of those factors.
Are you picking shares on gut instinct? Buying on press tips or rumours? Do you struggle to find the time to keep up with the research and analysis that goes into evaluating potential stocks? Stockopedia are pleased to offer a special deal to listeners of this podcast, a 14-day free trial and a 10% discount on the first year of membership. Sign up now at y.stockopedia.com/SFB. There's no better time to access the most comprehensive, easy-to-use investing toolbox for DIY share investors. 10% off, 14-day free trial and a 30-day money-back guarantee. That's y.stockopedia.com/SFB. So there are some recent events that are having an impact on Brambles. Tell us about those.
Yeah, so I've just given you the sort of rosy side of their financials. And indeed, that was backed up by the first half results, which came out in February, where revenue grew 10%, but net new customers were flat and like-for-like volumes actually declined by 1%. So that revenue growth was coming through price rather than volume. But then what happened is we had a trading update in April, and following that trading update, the share price actually took a tumble. And you'll see that if you look at the chart of the share price, there's quite a drop in April. Now, again, on the face of the trading update, it didn't look so bad. But I think what basically transpired is when you sort of dig into the numbers, their reported sales growth was 9%, and that was on track with what the guidance they had provided. However, that growth is coming from pricing growth, not volume growth, right? So volume has actually been declining, again, fell by 1%. And a lot of that inventory optimization, as we've talked about, from retailers and manufacturers. But the other thing was they're benefiting from price rises, but those price rises are really starting to taper off. And so the perception is that there's a bit of a slowdown, particularly in the second half, like the third quarter, and that will probably flow into the fourth quarter when those results come out soon. And so, with that price growth slowing, that was the perception that there was a bit of a slowdown happening, and hence the sell-off in the price. It has bounced or sort of tracked sideways really since then. But so that was what happened there.
So does that speak to any problems that there may be in the future? Because obviously sales growth is translated from increasing business internationally. And you think it sounds like there's blue sky in certain regions around the world. But are Brambles taking advantage of this to the best extent possible?
Yeah, that's a big question. I think their performance is very much tied to economic performance. So, if economies are booming, then there's high demand for goods. Those goods need to be put onto pallets, stuck in the back of trucks and transported to shops and warehouses, etc. So there is a strong correlation between economic growth. Now, as you're, I'm sure, all aware, we've been in an environment where interest rates have been increasing. And in some economies, including Australia, we're seeing a bit of a slowing in the economy. We're not looking at recession, although in New Zealand they're in recession, but here, things are slowing down a bit. But the major economies like the US are still proving to be quite resilient despite the impact of inflation and interest rates. So that's probably the primary driver of their outlook is, what's the world economy and, the major economies, how are they going to track over the next year, 2 or 3 years? But the other thing that they are looking to do is grow their business in some of those geographies where they have a limited presence so far. So that includes places like India, the Middle East, and Africa. So, yeah, there's still a lot of scope for them to grow their business. They are looking to do that. The market is fairly optimistic about their prospects. The market is forecasting EPS growth of 12% this year and then a further 11% next year. So overall, there's a fair bit of positivity around their business model.
I just wanted to get back to a comment that you made a little while ago, and that's about the bankruptcy risk and the kind of numbers that fed into that. Are these numbers fed into the bankruptcy risk and then in Stockopedia into the overall value score? Is that the way it works?
Not directly, but sort of indirectly, yes. So bankruptcy risk is not a direct component of the quality score, but some of the metrics that go into bankruptcy risk are. So if that makes sense.
Yeah, I'm interested in the complexity of the numbers that go into the 4 scores that you see on the right-hand top of your screen.
Yeah, I think there's something like 9 or 10 different ratios that go into the quality score, and some of those will also be, or very similar ones, will be contributing to the bankruptcy risk. Things around, the balance sheet structure, the level of debt, that kind of thing.
Okay, so any final thoughts, Chris?
Yeah, well, as you mentioned, the value score is the one element that is lower. It's currently 50, so that put it right in the middle. Now, what we find with stocks like this, it's a big company, it's a well-covered company, so it tends to trade at a premium to a lot of the smaller businesses on the market. So you generally will see value scores in not right up the very top for these types of businesses. PE ratio of 16, that's average is generally around 15. So, it's above average, but it's not a lot above average. Dividend yields 3.7%, decent, but not high. So, yeah, generally pretty good. Price to sales 2, price to book 4. These are decent numbers. They're not low, but nor are they excessive. So overall, a general comment would be it looks reasonable. And when you compare that with the quality, and if your emphasis is on quality, then it actually starts to look reasonably attractive.
So it just sounds like mid-range in every... It's beige. Its main colour is beige, isn't it?
It is the ultimate beige company in a sense, in that they do the most boring of stuff. There's nothing to get excited about. Like, it's hard when I'm preparing this. Normally we're looking for something exciting to talk about. What's exciting about pallets, But often it's the boring companies that produce the best returns over long periods of time.
Fantastic. Chris Batchelor, thanks very much for joining me today.
Thanks, Phil. Pleasure as always.
Thanks for listening to Shares for Beginners. You can find more at sharesforbeginners.com. If you enjoy listening, please take a moment to rate or review in your podcast player, or tell a friend who might want to learn more about investing for their future.